Good morning. Welcome to Option Standards Thursday, about 11:30 a.m. Eastern Standard Time. This is a very, very important video, and this video is going to complement a video. Let me pull it up. I made a video on Treasury rates will force market crash. I'll force the market to crash. Now, this is a extremely important video. And I'm going to explain, I'm going to complement. It'd be really wise to watch this other one that I had. It was only about maybe a week ago. And it's so important because it has to do with the overall economy and a recession that is looming. And not only is it important for trading and your portfolio, but it's also important to learn, this isn't good. There's going to be a lot of people that are going to be unemployed. There's going to be some pretty tragic things happening. And, we don't know the extent of it. It's going to be like 2008. Is it going to be like, Great Depression? Who knows? That's not the point. It could be a shallow recession, but it does loom and it's going to affect people. So it doesn't make me happy to be bearish, but I am. And everybody's super excited right now that the market is near all-time highs, and maybe it does eke out all-time highs. The Dow did, but I do have a wave count. It's a bearish wave count that it's very bearish for the Dow as well. And this party can keep going. Maybe this is a new bull market, and this time it's different, kind of thing. But 100% of the time, when the yield inverts and comes out of that inversion normalizing, a recession follows. So sometimes the recession starts a little bit sooner. Sometimes it takes a little bit of time. Now, I'm going to go through SPY, QQQ, IWM, and DIA, and also the VIX, just to give you a sight of where we are, just in an overall. I'm not, the market could go up a little higher. It doesn't really matter at this point. I'm very humbled by this move. It was extreme. Lost some money. I actually was bearish towards these areas at 440 or so, and it just kept ripping. And now I can see why. The market gives us information. We have to switch as traders. Unfortunately, I'm not switching to a bull, but I've relaxed on the trading and scaled in on some more spreads just to give time, because we don't know time wise when this is going to happen. So enough rambling on. I'm going to go through SPY, QQQ, DIA, IWM, and VIX. It's very important you stick through this video, because after that, that's when I'm going to repeat some of the topics on the rates. I'm going to show you from the CME, the FOMC. We're going to take a glance. Where's it at? And we're going to take a glance at this, the Fed tool, and the 2-year, and show you some of the things that I'm looking at. Recession is near. Okay, so if you're new here, go down to that bottom right-hand corner, hit that Option Standard logo, and subscribe. Hit that notification bell so you can get these videos often. Every time the information starts to change, it's a very linear type set of videos. It's like a book, chapter after chapter, and we update these all the time. So don't forget to like the video. That helps us keep this channel going and spreading the word. Okay, so we have SPY here. We have a consolidation area, this zone. We made it through this zone really quick with the FOMC yesterday. So we had a huge move right to the top of the zone. So we're at resistance here. We're terribly overbought. We have the top of this wedge channel. I said yesterday that we had just a little bit more room to the 472 area, and we're right at that area now. We're overthrowing this wedge just a little bit, but this may be it, folks. This might be the end of our move. If we start to retrace, it's probably going to be pretty intense. And what I'm looking at projection-wise is to hit the bottom of this wedge in some shape or form, and then get a bounce, and then head lower after that. And how much lower? It should be a pretty intense move because of our situation, and we should start seeing the effects in fundamentals, and a lot of the employment data and things like that should start to deteriorate from the effects from the rate hikes that the Fed has been doing. But the market is the one that's going to force the Fed to lower its rates, because the market controls the Fed, not the other way around. Okay, so we had our consolidation zone here on QQQ. We're above it. We're actually at these breakdown candle areas up here, right just a few points off of all-time highs. So we're at another resistance point here. Can it go higher? Sure. It's proven that, and we have room for the top of this wedge as well. And I've been saying video after video, QQQ, the Qs can hit all-time highs. Doesn't matter to me. I was skeptical about the overall market hitting all-time highs with the stance that we're in timing with this yield curve inversion. We've been in this inversion for well over 500 days, and that's near the longest inversion in our history. And so that's time-wise, it's just it doesn't seem to fit that we continue to move higher, much higher, especially a brand new bull market. But the Qs can make new all-time highs. It doesn't change anything. What the view is SPY that I am kind of skeptical about that hitting all-time highs. Now, if you look at IWM, just a straight shot. But really, all this is doing, I didn't just draw this. I drew this months and months ago. And what this is showing is that we're still in the channel. It's just we went from the bottom of the channel straight up to the top. This is today. This is resistance. Now, there a while back, I was showing that in a really bullish situation that maybe this heads up, makes a higher low, and continues to move up higher before we reverse. I don't think that's going to happen because of the time frame that we have with this inversion. So it's all about the timing. I do think this is a resistance, and I think we go down from here, from this point. And so that leads me to believe that the market is near its end as well, if it hasn't just ended today. The DIA, the Dow Jones ETF, has made all-time highs, but this one is its own beast. It's only 30 stocks, so it had its move down, and in my opinion, this is the initial move A. This is an overshoot as a B, and we're going to see relative strength. Even though this is going to have a massive move to the downside, it's going to have relative strength because these are some of the the darlings of the little bit safer stocks to say, and we're going to have a massive move down, much lower than this low here, but it should move a little bit slower pace than the rest of the market, because these are stocks that, like Coca-Cola, for example, will I don't know for sure if that's in the Dow, but that's an example of the type of stocks that people are going to flock to with the yields. Okay, the safe havens. All right, and treasuries, which is we're going to go over to. Before I jump ahead, we want to take a look at the VIX. The VIX is right in the zone. Let me give you a different screen here. The VIX is right here in the zone. That $12 zone has been stuck here, and we think we're going to start moving out of this channel from this zone. It does have a little bit room lower to go, but I'll put this on the weekly to give you an example of why we're in this complacency area. How about a monthly? We need more time there. Okay, so we're right at this point where the markets are terribly bullish, and we're in a bull market, and that's not our situation. So we're down to this point, and as a bear market, we're near extremes, and we're gonna reverse off of this at some point. Again, I think we're at that point. We're at the extremes on all the indices. And we hit this level, and I think we start breaking out of this channel for much, much higher moves. And that's going to take the market down with it. The VIX is bullish, meaning the market is bearish. The market's heading down. Okay, now to some of the things that we were talking about. TNX. Okay, this is crashing. I told you different scenarios that that could normalize the yield curve, but the likely one is that the 10-year, this is the 10-year Treasury yield, so that means that it says 38.97, but really what that's saying is a 3.898% yield on the 10-year bonds. So the bonds are rocketing right now, which lowers rates. Now, bonds are a very safe haven situation when you're in a recession. And so that's why those are taking off, and rates are dropping extreme. When you have extreme moves, it's going to affect the market. The market has been inverse correlated with rates. As rates go down, the market has gone up. Okay, so that inversion, that correlation, inverse correlation, is going to break at some point, and that's what was so important about the video that I put out before. Now that this is dropping so hard, the initial move from the market is saying, yay, oh my gosh, we're getting these fantastic, we're going to get rate cuts, and rates are going down. All is well, and the market's just jetting to the upside. Well, I think we're right at, I think that 4% yield was the breaking point. Okay, that was yesterday that we got down to that 4% yield. Now we're dropping below 4%. And why is that important? Because it controls the Fed's move. And when the Fed starts cutting, that's when the recession hits. They're seeing something that we don't see. The market is 6 months forward looking, and it's seeing things that we don't see yet. So that's why we watch price action on the market. Okay, I'm trying not to rush through some things. I know this isn't a glamorous type video, but this is super important to follow for individual people, for your businesses. It's so important. The economy, the rates are crashing, and the market is soon to follow. Okay, that inverse correlation, it's going to correlate soon, and I think that's happening really as soon as today. That's why I'm putting out this video. Okay, so this has much further. We're getting to these support areas. It's not going to go in a straight line. You're going to have bounces or so, but as soon as the market breaks the inverse correlation, it's not really going to matter so much the little bounces that we have. It's not going to control the market. It's just going to break at some point, and the market's going to say, oh my gosh, we're having a recession. That's why rates are going down. Okay, now I'm going to put up our comparison. Okay, so here's the comparison chart with the SPX. That's the market is in purple, and then the red and green chart is the rates. And if we look back to even as soon as the Corona crash, rates started to drop while the market's going up, saying, yay. And then at a certain point, it just cracks the market and the market just dropped. That was a very extreme move. It was a historical move. Now, excuse me. Now going to 2008 into 2009, it's the same thing. You see these small periods of rates going down and the market's loving it. And then the rates start dropping pretty rapid and the market's going up. And then eventually the market sees rates crashing more and the market correlates with it. Extreme. And it starts to accelerate both the rates and the stock market, because it's saying we need zero rates. It's going to force the Fed to zero fund rates so we can fuel the economy. It's saying we're having a recession. Things are bad. Employment data is bad. All the economic data is bad. And, and down here, just to be honest, down here, you have the worst information coming out, but that's actually the best time to start buying the market, because the market, you see the rates start heading back up. The economy is looking better and the market starts bouncing fast and hard. So I think this is the situation we're in. I think this is kind of where we are. Rates are dropping dramatically. The market's going up. Rates are going to bounce. The market's going to head down with rates after. And I'm not being real particular about the bounce itself, but as rates go down, the market's going to say, shit's hitting the fan. Okay, so this is the most important chart, and it happened the same way in 2000. We have the tech bubble. Same way, rates started going down. The market just shoots higher, loving it, and then rates pop up, but start to head down. Market loves it some more, and finally said, doesn't make a new high, but gets right there, kind of like where we are right now. All-time high, right to all-time high, right before it, and crashes, just completely crashes with the rates continuing to fall. All right. I'm not doom and gloom. That's just what happens. That's just how it happens. All right. I think, let me pull up and you can look this up yourself if you want to look into the CMEgroup.com. You can check out the 2-year yield curve that tracks with the Fed fund rates very, very well. And so what's important about this is that you see the 2-year rates. You see the 2-year rates starting to fall. It's been falling since October, and that's going to force the Fed fund rates they're at 5%. They're behind the curve, and so the Fed is going to have to drop. We're down here right now. We're down here at about 4.43%. And the Fed did not cut rates this time around, but they're at 5%. They're going to have to cut to catch up with this 2-year yield. So this is telling us we're getting our cut. It's forcing the Fed to cut. So it could be as soon as January. I don't know, but March looks pretty likely that we're going to have that cut. And so that's where my insight on the market, we have till about, the markets can start dropping before the cut happens, but before the Fed pivot, quote unquote pivot, but it doesn't have to wait till March. But ideally, you still could see the market rise and do some things into March, and then finally get our acceleration from the Fed cut, the pivot into March. Now, it could happen. It could be forced to happen in the Fed meetings in January too. But that's really, really soon. That's next month. So those things we can't really predict too precisely. Let's go over to the yield curve. So here's the curve that we're talking about. You have the 10-year right here. That's at 3.8%. And you have the 2-year. That's at 4.2. This was much higher. Now it's starting to, this is an inversion. The 10-year, you should be getting a higher yield rate for a longer dated bond, treasury bond. The 2-year is going to eventually come down faster than the 10-year. So now our line is going to steepen. Okay. So this line is going to look more like a curve up, where you're getting less of a percentage from the yield than the 10-year. The 10-year should be higher than the 2-year. So this is dropping faster than the 10-year. Okay. And that's what's putting us into a recession situation. It's saying, hey, we need to stimulate the economy. All right. This channel does not, I don't focus on fundamentals, but this is the only thing that matters right now. And so I have to put this out there. It's the only thing that matters. And then all the rest of the videos will kind of direct us and, hey, what's happening now? What's our projection? Are we getting a bounce soon? Are we headed down or headed lower? That's what the channel, the technicals, that's what I usually look at. But this is so important. This is for the, this could be a recession for the next couple of years. In the case of 2000, the market didn't see new highs for I think it's almost 13 years. Yeah. So, and we can give you a visual of that too. So this is a possible scenario. And let me change this. So this is just an example here. Here's 2000, where we had our tech bubble. There's the top of 2000. Had our recession. Almost a 70% pullback, 50% pullback, I believe. And then we had an 80% pullback in tech stocks. So quite a sharp pullback. And then we had things get better into 2008, where the market was stimulated to reach not a new high, but a double top right here. So we didn't get new all-time highs, and then completely got smashed after that. This is called a flat pattern. We have an A, B, C correction, and that took many, many years to happen. And we didn't see all-time highs until around May of 2014. May of 2014. So it's we had about 13, 14 years before we even seen all-time highs. So if you bought here, it took you 14 years if you just held just to get back to even. All right, we're in a massive move. We could see some sort of correction, flat correction like this. It could be something more sharp. It could last quite some time, similar to this. These are recessions. All right, and we do expect to recover out of all of them, but just in different ways. So now I'm just rambling on. That's what I want to show you. Make sure you check out that video. I'll put a card. I'll pin it up top and at the end of this video. Thanks for joining us. Make sure you hit that like button. And sorry for the bad news, but it's necessary to take a look at. All right. Have a wonderful day. We will talk to you tomorrow.